Hello and welcome to this edition of the video market update from Orbex, or in collaboration with Orbex, from me, Nour, El-hammouri. So beginning with the US jobs report, which basically came in with mixed signals. The NFP, or the non-farm payroll, added more than 200,000 new jobs, which basically around 220,000 new jobs. Yet the unemployment rate increased again for the second month in a row, as the participation rate also increased last month. And this is one of the main things that we'll be following over the coming months. And if you're asking why I'm going to be looking at this number, especially the participation rate, here's the answer. Mr. Donald Trump, or the President of the United States, Donald Trump, is encouraging the company to go back, or to bring back the jobs to the United States. Moreover, he's still saying that there are creating a lot of new jobs in the States, but this is basically, or this is encouraging also the people to go back, or the workers to go back into the labor force and look for new jobs. However, at least for last month, they haven't found any. And don't forget, this is only just January. It's only 1 month, so it's not, we can't say that this is or generalize the things. But when workers seek, or the workers who basically seeking for jobs return into the labor market while they haven't found any, the unemployment rate will automatically rise and increase by the month. But this is also the case since the financial crisis until today, where the participation rate has been declining significantly side by side with the unemployment rate. And therefore, I'm still not convinced with what so-called the labor market recovery, or even the full employment that the Federal Reserve is talking about. But the next few months will give us more evidences regarding this sector. Finally, of course, the wages slowed down again and increased by less than expected. The US dollar index also declined following the news, of course, because of the slowing wages, which basically means that there is no inflation pressure so far, at least for the wages. But today, the US dollar index also recovered most of these gains, but this is also due to the court decision in the States to block Mr. Trump executive orders to ban refugees and some countries to enter or some people from some certain countries to enter the United States. Yet, the US dollar index closed last week below the 100 with 100 barrier to complete 7 weeks of consecutive declines. As for this week ahead, there are only few economic figures and events throughout the week which may have a notable impact on the market, but in today's video, we will take a look at some of the assets that we have been following since the beginning of this video series. Beginning with the US dollar index again, the one I was talking about earlier, technical chart, and this is the weekly chart. And first of all, I would like to mention here, first of all, that the US dollar index here that basically completed or ended the 7 weeks of consecutive decline since almost since the beginning, since December of last year until today. We had 7 weeks of consecutive declines, and most importantly, we had those two tops in here, the former resistance back in 2015, back in 2000, also at the end of 2015. And we had a breakout in 2016, at the end of 2016, with a retest in here, and then all the way back up until we reached almost the highest level in almost a decade at 103.50s. But this was a rejection, and then since then we have been declining for 7 weeks. And most importantly here, that we already closed last week below the 100 barrier for the first time since 18th of November. And this is very important level to watch throughout this week, because first of all, we might see a test of that barrier, which is 132 right now, and also between 100 and 132. This is a very important level to watch out. But for the time being, the bullish outlook for the US dollar is still positive. But at the same time, we should not also forget that this is only, or for the time being, it shows that it's a short-term retracement to the downside. But looking at Fibonacci levels, the first level that we have to watch out is again the 38.2%, which was tested already last week at 99.32, and it was rejected. And maybe the second level would be the 50%, which also almost at the same level of the medium-term trend line since April of 2016, which basically stands at 97.92. But this is if the level of 132 holds perfectly or during the next few days. So this is beginning with the US dollar index. I would like to show you a chart exactly how it looks like for the time being, and this is why we're watching at why we're watching a level or the 100 barrier. Going into also the rest of the numbers or the rest of the charts, beginning with the euro dollar again. This is the daily chart, and as we mentioned, this is the same chart that we've been using since the beginning of this video series. But again, we tested the 100-day moving average on the daily chart, which basically last week or the beginning of last week. But so far, we've seen many rejections. The first one was on Thursday. Friday was a little bit also just to close with a closing positive. But today, at the beginning of the week, we saw this sharp almost decline since the beginning of the week, or since the beginning of the day. The opening, and then we saw the decline. However, this is still some sort of, for me, there's still positive for the time being. But we have to watch again from the level that we basically tested and then continued all the way down. The 100-day moving average is not an easy. It's not an easy level to break it in the next few days. But we have to keep an eye also for the next few days how this may react. For the time being, we've seen like a full week trading below that level, which basically should be or should give us a sign that we have to see some downside retracement. And at least for the time being, if we took it from the lows all the way to the top, we're stuck above the 32.6 so far. This was a rejection earlier this morning, but the 38, which is 38.2, is possible to see at around 106.50s before the buyers were basically likely to appear. At the same time, the technical indicators are not positive enough to give us another push all the way up. So I'm guessing this would be the week that we might be seeing some sort of a downside retracement to the downside all the way back to 106.50s. This is highly possible. Going forward to the Japanese yen, and the Japanese yen is very interesting again because it's showing us that the 76.4% for Fibonacci is still holding so far. Sorry, not this one. It is still holding below that level, which is almost 63, 68, and 74, 61, and 74. This is still a very important level to watch. Last week we had this negative bearish engulfing candle on the weekly chart, which basically opens the way for further downside. And this is what we've seen at the beginning of this week, all the way back to 12. But don't forget that the Bank of Japan has intervened also last week, but it failed to keep the dollar yen above the 113. And here we're seeing another leg lower. For the time being, as long as it stays below last week lows, I guess we might see that. Sorry, that's the monthly chart. We might see some sort of more downside ahead. But looking at the weekly chart quickly, it is the same. There's no big change, especially that the same level is still holding in here, and this is also the same level that we basically got rejected from, which was back in August 2015, and now we tested this one for almost like 3 weeks and then all the way down. Now we are below the 100-week moving average, which is very important to watch in the next few days and in the next few weeks. But technical indicators, as I said, is still negative. Most likely we'll see more downside ahead, but we have to watch also some technical levels on the Fibonacci on the weekly chart, which is around 1130s, and also the 200-week moving average around 109.17. Those two levels should be watched very carefully this week. As a break through those two levels, there will be a very significant breakdown to the downside. British pound again, we managed again, as I said last week, we managed to stabilize above the 150-day moving average. At the same time, it was a failure to break above those two tops in here, or double top in here. So this is a double top formation is still in place, but at the same time, if we zoom in a little bit, I guess the 50-day moving average should be watched very carefully in the next few days. And don't forget that the Parliament is about to issue a statement about the Article 50, and the debate is ongoing during this week. So I'm guessing at the same time, or for the time being, I won't be touching the British pound that much, but it will be some sort of a retracement to the downside at least, unless if the Parliament approved the Article 50 and the Brexit plan, or the white paper that the Prime Minister May has published. I guess we will be seeing another leg lower all the way back to the 22s area. This would be my best case scenario for the time being. Going forward to gold. Gold is still going within the plan that we noticed, or the one that we mentioned in our previous videos. Breakout last week, a breakout today also. There is trading above the 100-day moving average, which is very important, and and it's actually at the top of the session right now. It's Monday night. It is still above the 100-day moving average, which is for the first time since almost September of last year. We've seen such a breakout. However, if we look at also some Fibonacci levels here, I guess we might see the 61.8% very soon, which is around, I'm guessing, somewhere around the 1237, which is also another resistance area back in April 2016. Therefore, I think so. The technical indicators are still positive, but we might see some sellers coming in around above the 1230 in the next few days. But I'm still positive on gold, still positive on silver at the same time. I still think that we might see more upside ahead, especially that inflation is still picking up. Geopolitical situation around the world with the new presidents, with the new U.S. administration, I guess this might have more room to rally in the next few days and next few weeks. Silver, if you want, also we can include it. Silver is still outperforming gold this year. 7 weeks of consecutive. I guess it's 7 weeks. Yeah, it's 7 weeks of consecutive 7 weeks of consecutive gains so far. 1, 2, 3, 4, 5, 6, and 7, and we're trading above the 50-week moving average. This is very positive for silver, and I guess I'm guessing we will be seeing more and more upside in the next few days. The 38.2, I guess it's also significant to watch in the next few days, which is 1770s, and then we'll be looking at the moving average, which is going to be around 1804. This is also psychological resistance that you should keep an eye on. Finally, the U.S. equities. I'm still not interested to trade any of them, but again, we're still stuck within the same range even after that we break the 20,000 on Dow Jones. But it is still some sort of a very heavily overbought for me on most of the time frames, excluding daily, but weekly, monthly, and quarterly, it's heavily overbought, and I'm still not sure if I would be able to buy it from here or even to trade it for the time being. So I would definitely stay away, but I will be just watching for the time being, especially for the U.S. stock market. So this is it for today. Again, traders are advised also to follow Mr. Donald Trump's remarks, as he is moving the market more than the central banks is doing nowadays, but through his tweets or through his Twitter account. So far, he haven't included the Federal Reserve in his orders, in executive orders, or even his tweets, but he might do anytime in the coming weeks or even days, but who knows. For the time being, again, as I said, we need to keep an eye on his remarks, as they are moving the markets more than anyone else, at least. Thank you for watching, and I'll see you once again next week. If you like this video, you can like it, follow us, and also share it on your social media. Thank you again for watching. I'll see you once again next week.